Here we go. We are live. Very good. Very good, everyone. I can see that some of you are already coming in the room. Welcome to the session, my friends. We are about to start in just a few moments. We're just gonna wait for a few more students to enter the room as everybody's logging in now at this moment in time. But very nice to see you guys entering the room and joining us again for another beautiful webinar with Josip. Welcome, my friends. And we are just gonna wait, let's call it 1 more minute before we go. Okay, guys? Thank you so much. Very nice. Well, in the meantime, as we are waiting for this 1 minute, I was just, looking around on the platform just to make sure everything is smooth. But while we are waiting for during that 1 minute time, what about you guys? Type a quick hello on the chat box, as some of you are already doing. How are you, Ahmed, Orlando, Fernando, Wayne, Robert, Dirk? Very nice to see you guys. Very, very nice to see you. What about you? You share with Josip a little bit more about your trading experience. How long have you been trading options? That, just a very short sentence, 5 words maximum to kind of summarize, how long have you been involved with options trading, no matter if it's real or simulated, how much have you been a friend of the options markets? Because if you become a friend once, then you become a lover and a passionate trader of these beautiful options, isn't it? Wonderful. Nice meeting you here as well. Team, Mario, good to see you. Very good. So long time for Wayne. You need more than 5 words, you need, Wayne? Very good. I'll let you guys type, and while you guys are typing, I just want to say now an official hello and welcome to everybody in the room. We are now going to start the webinar. I also want to say hello to Josip, which again it's joining us and has prepared this fantastic webinar as a continuation, part 2 of the prior webinar that we did the other day, like a week and a half ago, something like that. And very exciting, because really we could not have part 2 without part 1. But if I can say, Josip, you tell me if you agree or not, but if I can say, this is the real cool one, because the other one was basically building the foundation to talk about these alternatives and these subtle changes that make a major difference. So, but anyway, Josip, welcome to the session. Welcome everybody, and I will now turn myself off, microphone and camera off, so you can lead the session with the students. You guys take care, and everybody have fun, and please use the chat box, ask questions.
Thank you once again for having me, and I want to express my great gratitude for all of you who are attending this. As Jose pointed out, synthetic long that was presented earlier was actually necessary evil, because you don't build an alternative unless you understand almost like a disadvantage of ponying up that much cash for particular trade. So I'm more excited about presenting this alternative than what I was presenting the first one. So without too much hesitation, I prefer to jump in, because I understand we have a limited amount of time, and I do want to encourage you to type your questions in as we go along. And at the very end, we also going to have a time to have a Q&A. So I'm going to present first alternative, and unlike the part 1 demonstration, in this one, no outcomes will be presented because I'm out of that trade. I got stopped out before the expiration took place. And I want to compare the original long synthetic when it got stopped out versus the one that is alternative that I'm going to present it now to you. And I want to emphasize the word alternative. You should think about more economical, cheaper, wiser in a way. But we can only be wiser once when we know what the base thing is, right? So please keep your mind open to the possibility. And the most important is that we have a flexibility. Just because we are getting into something that is a longer term, it doesn't need to be that we are holding on something all the way to the end. Similar to, let's say, somebody bought the real estate with a 30-year loan. Well, they might live in that house only for 5 years, right? So be aware of it. We are getting into the longer term option that might go out 210 days, but we can be out whenever we choose to, or whenever the technicals are actually indicating that the trend is turning. So as I said, use the chat box. There's going to be Q&A at the very end. Jose is going to again pop up in, and we're going to then wrap up the session in about an hour. Okay, so I like to say that just like a playing an instrument, like a violin, grasping a single option trading tactic, and I want to really use the word tactic rather than a strategy, because I think strategy is way too broad, right? Playing the same instrument repeatedly breeds in familiarity, brings this kind of comfort, So just as the combined notes create the music, many options put together produce, and I was trying to find the word to finish that sentence, and I just chose the word beauty. And as I go through this, you'll understand why I point out the word beauty. Because when you understand the option, and I hate to use this example, but it's almost like comparing the old black and white TV and watching I Love Lucy versus color TV. And what I mean by that is the black and white TV is pretty much trading equities. You don't have that many options, like you need to be right on the direction market either goes up or goes down. But we all know in reality, market can do what it does today, diverging, like one market is going up, let's say NASDAQ is going up and S&P is going down. What do you in that case? That's when the color TV kicks in. That's where the options kick in. So the practicing violin is a daily commitment, just like the trading is a serious commitment, so how do you become a trader? By trading. How do you become good violin player? By playing the violin. So one who wins is the one who practices. And this is a universal truth, because what is most personal is also most universal. So I really want to emphasize, trying to focus on less option tactics when you are learning the art of trading option is really what matters, And I'm going to now move on to trading with the UFOs, which really helps you to see unfilled orders, and then you build your strategy around it and your tactic. So 2 steps are usually used to prepare us for trading that particular option tactic. And the first one is, of course, auto climate that defines the environment, whether or not we are on the right side of the market. So the long synthetic, the word long by itself is supposed to translate in your mind bullish bet. So that's mean on the auto climate, we would like to see this blue histogram, right? And of course, the auto unfilled orders are the ones that are showing to us where the green UFOs are, so we would know where do we need to place our stops. So without any hesitation, I want to go through definition of what is synthetic. So synthetic is really something that is not of natural origin. And I know, like in the media, you can have a lot of synthetic stuff, but in reality, something that is artificially made. So what I'm showing right here is an option that was entered on October 22nd, when we had 210 trading days till the expiration. And on the left side, we have calls, and I purposely have selected only 2 strike prices, 19 and a 20. And I want to emphasize it's a 20 that I really want to discuss. So this 20 is where your focus should be. So we have here bid, we have an ask. So $20 call would cost me $2.15 per share, but because with option contract, everything needs to be multiplied by 100, that would cost me $215. And my logic as an option trader is that my debit structure should be paid by the credit structure. And I know that's a mouthful, but I'm going to repeat one more time. Buying of the call would create the debit, but I like to finance that debit of the $215 or the $215 by selling something. And what can I sell against it? Well, I can sell right here on this side, this put. And this put also has a bid and also has an ask. And I want you to observe right here that my put is actually 2.78, which is credit that is greater than the debit that I'm receiving right here. So this is what I really want to point out to you. Like Fernando typed in the chat box, trading option is art, and we actually need to be able to think outside of the box. We're not watching the black and white TV. We're not looking at the trading stock that we only make money on the long if it goes up, or on a short if it goes down. With this one, we can actually have the multiple possibilities. So what I have done with the original long synthetic, I have tied up about $2,000 in order to take an obligation to purchase American Airlines, and I have received a credit of the $278, and I instantly turn around and finance my long call. That's what I did on the last presentation. That's kind of quick reminder of it. So what I did over here on the next slide, not to kind of complicate and repeat myself too much, I have taken the trade ticket from the platform called Thinkorswim. And starting from the top to the bottom, I have entered that trade. I have entered that trade right there on October 22nd. It was exactly at 10 in the morning that I have entered that. And it was called a combination because I was buying one and that was a $20 call. And then I was selling one and that was a $20 put. So if I just jump back for a second on a previous slide, you will see over here, it's a bid on a $20 call. The bid on the $20 call, it says a 210 and ask is 215. By the time I actually got filled, I have gotten something that's called price improvement. And this price improvement that I have gotten was $2.11. $2.11 I have gotten it. And for that $2.11, I have sold, and I'm going back to the previous slide to point out to you, not at the 278, because the bid and ask always has a spread. So if you're reading right here on this bid and ask spread, you would notice 278 and 280. That is a 4-cent spread. What do you think it's in the middle? Well, in the middle, it's really 280. So in the middle is 280, and I was able to get right here 280 for the selling of my $20 put. So when you take a 280 and of course subtract the 218, I was able to keep the 69 cents of the credit. So I'm going to repeat for the third time, my goal as an option trader is not necessarily just buy. My goal as a trader is to have a debit structure functioned in such a way that would get financed by a credit structure. So my 280 credit paid for my 211 debit. I have received the 69 cents of the credit. And now I want to take a moment and read the lower part of this ticket. The lower part of this ticket is this area that I'm circling right here that has all the information that we need to focus on. So although I have two legs, one is a bought call that gives me a right to buy at the 20 if the price of the American airline that at the time At the time, American Airlines was really at the $19.23. So that's mean that really my $20 call was slightly out of the money, or it was near the money, or we call at the money. So it's not $20 call that is really a driving unit in that particular trade. It's actually $20 put that is an obligation that is forcing me at the expiration, which is 210 days from the entry, to have a $2,000 tied up to purchase. But because they gave me 69 cents, when you do the math in your head, which you don't need to do the math in your head, $2,000 minus 69 cents give you this break-even point that is highlighted right here in yellow of the $19.31. So you might be puzzled by that, and it's like, where did I got that? I got that from a $20 that gets a 69 cents subtracted from it, and that is a 931. So my maximum loss on this trade in a dollar amount would be $1,931. So this is a kind of expensive trade, but this is a trade that I presented the last time when I was introducing the long synthetic. So if you don't have any questions, I'm going to now proceed to the next thing, which is a breakdown of this in the form of the table, because last thing that I want is one of you in this room to get lost because you did not pick up the two different pieces that I'm talking about. So I'm going to just read this one more time slowly. Synthetic long is composed of the two components, call and a put, but they're not both purchased. One is purchased, and that is the long $20 call. So long $20 call that is purchased right here, it's creating debit. And that is costing me, and you saw on the ticket, I got the price improvement of $2.11. So I'm good with that, but I want to have my debit structure financed by the credit structure. So now I'm moving to the second part of this table, and I want to emphasize to you that I'm now shorting the put. Shorting the put actually reverses the put from making it into what I like to call double negative, because put by itself is negative, and when you short the put, negative times negative, it creates the bullish bias. So I want this $20 put at expiration to be worth zero, so that's mean $280, so the $2.80 per shares that I have received, I'm going to keep it all. That's my goal. So now I'm done with talking about just these two legs, and I'm going to be focusing right now on a total or on a difference of the debit and a credit. So when you take the 280 credit that I had received and I subtract the debit, you see that I'm actually ahead by the 69 cents. Now, the 69 cents or the $69 is what the brokerage house through which I traded, in my case, was a Thinkorswim owed. And the way how they do this is they say, okay, instead of holding from you $2,000 of cash, we actually owe you 69 cents. So we want to do with the 69 cents, simply reduce your margin to $1,931. And that's the end of my presentation from the last time. You know, this is how much money I had online, and this is what it is, right? So perhaps we might be unwilling to tie up $1,931, which is a huge amount of capital, for a 210 days. The question that I'm posing right here, and I want you to kind of stay here with me, is just to think about it. Could there be more economic solution to black and white if we have a color television? You know, and the answer should be yes. There isn't a more economic solution than just selling a put to pay for the call. Okay? But in that case, what is going to happen to delta? Well, delta would be slightly reduced. But boy, if I can reduce my maintenance, my margin, I think it's worth a try. I think it's definitely worth a try. So I'm moving here to the B point of this presentation because I want to make sure that you're following this. With more option trades, there's a pros and cons. And I really need to emphasize first the negative. It's not going to be only 2 commissions, it's going to be more commissions, right? That's the one thing that you need to be aware of it. The next thing, after selling the higher put, which higher put, it's giving me an obligation. I can actually go ahead and buy the lower put. And in that case, I reduce instead of $2,000 on the $20 put. Margin by less. So I want to remind you that there's also another negative. The credit that is going to be received from this put spread will not, and that's why I purposely put in this upper case letters, not be enough to finance entire cost of the call. But there's always pros and cons in life, and there's always pros and cons when we are trading options. So having nailed down, having presented you all these negatives, I want to move on here and explain to you what is really synthetic log alternative. So synthetic log alternative is the 3 pieces. So each of these option trades must be explained individually, and we're doing good on time. You know, I'm barely 20 minutes in it. I have like more than 40 minutes to actually explain these 3 pieces in isolation. So when I explain all these 3 pieces in isolation and put them together, that combination, that quote-unquote Frankenstein, because what was a Frankenstein? Frankenstein was a alive being composed of the different parts, right? That's pretty much something artificially created, or another fancy word for it is synthetic, you know, and I like to use the word synthetic long alternative, right? Is composed of selling at the money put, and we already know that that is going to be the 20. So we're going to be still selling the 20 put. We're going to be buying out of the money put, and in a moment when I click the next slide, you're going to understand which put we are buying. And we're doing these 2 transactions, which I like to call the put spread, in order to pay for my at-the-money call. But as I disclosed to you earlier, I will not be able, with the credit that I received, completely to knock this thing off. But on a good side, I would reduce at least majority of it. So one more time, I'm going to repeat. Step 1, we're selling at the money. Step 3, we're buying at the money. And look at the step 2 and type in the box, chat box, that you're recognizing, just like in the Sesame Street, one is unlike another. What is the number 2 that is different than a step 1 and a step 2 in terms of the moneyness? And as you're typing this, I'm going to patiently move on to the next one. It's out of the money. So step 2 is out of the money. So only one that is unlike the step 1 and step 3. Very good, Fernando. It's out of the money. And I'll come back to this later. So that's my hedge. That's my just in case something goes wrong. So I'm going through the step 1, which is the selling at the money 20 put. So we know that selling at the money 20 put would provide the credit, but at what price? At the price of the obligation to buy. 20 put times 100 means $2,000. So that's mean $2,000 my broker Thinkorswim is going to tie up as a capital. So the way to reduce this $2,000 of margin is also to purchase a put. So now I'm moving from a step 1 to the step 2. So what do I do now next? Yeah, somebody said like a Dirk. So this is a triangle with additional leg. Yeah, you said it. You know, there's many different ways to call this long put. I personally, if somebody says to me, find a better way to name this long put, I would call it protective put, and I'll get into that. But Dirk, I like the fact that you recognize that. So it's true that you're traded for a long time, right? So buying out of the money long put is gonna also produce the debit. So there's a couple of things that I need to disclose, and I like on this slide I only have 2 points to make. One, it needs to be on the same expiry. Okay, so same expiry needs to be selected for both of these put units. And point B, the execution should be done at the same time as the spread. And the reason why I say it should be done at the same time as the spread, because then I can a little bit shave off that bid and ask spread that exists and have something in my own advantage. So if you're good there, and if you don't have any question, I'm going to just proceed. But if you do have any questions, I'm monitoring the chat box virtually all the time. So here I'm showing only the put side of the American airline on that particular day, which was October 22nd. And I like to emphasize that the less is actually more. So I'm going to go over here and point out to you that this 20 put is the unit that ties up to $2,000. So we have here additional column on the put side besides the bid and ask. We have a word volume, which is a volume traded in contracts that day. This volume is not the volume of the American airline because that gets counted in shares. So when you're looking at the $16 put, that morning it was traded 221 times. 17 put was traded only 18 times. 18 put was traded only 33 times. And a 19 put was traded, I believe this was the 26 times. I can't see this, I made this circle around it. And then the 20 put was traded only 7 times. But that's the one that I'm selling. So that's the one that after I execute, it's going to change from the 7 to 8. While over here, the 16 that I'm going to trade in a moment is going to change from the 221 to 222. So obviously, my selection was done based on the highest option contract value traded on that day, October 22nd, at that particular moment in time. So I'm moving on here to the next slide that is going to show the actual ticket of the Thinkorswim platform. And if you are now paying attention to what I said on the earlier slide, if I'm in the same cycle and I'm doing the puts, that creates the position in terms of the spreads that it's called vertical. So right here you have a vertical spread that involves selling, here's a minus sign, of the 20 put. And over here, B stands for buying, and there's a plus in front of the one, of the same expiration, which is May of the next year, but of the lower put. And that lower put, one more time, I'm going to ask, and I see Mark Johnson has typed the correct answer. It's out of the money. Fernando has typed in out of the money. And you have seen a minute ago when I was pointing out to you that all of these 16, 17, 18, and 19 are all out of the money. Because if I'm selling something, the logic is sell high with intention of the buying back low. So the market maker presentation of the volume on the Thinkorswim platform has shown me the contracts that were traded that particular day. So that particular day, 221 contracts were traded on the 16th. Therefore, I have selected the 16 as my lower strike price. So I want to now stop right here. I know on the next slide, I'm going to again have that. And I want you visually to look at it. 20 minus 16, it's only 4. So that's mean I would be reducing my margin from $2,000 only to $400. And of course, my credit is not going to be $280 because I don't have only one leg. I have two legs. And that second leg that I'm having is the one that I'm actually purchasing down here for about $1. Okay? So it's for about $1 that I'm purchasing, $1.05 that I'm purchasing this on an ask $16 put. It's creating this credit, and I'm going to circle it right here for $1.70. So now I hope you can visualize this. Had I done just a long synthetic with the $20 put, it would bring me $280, but then it would tie up $2,000. I'm doing this $16-20 vertical put spread that it's tying up $400, but it's reducing my my 280 credit into 170. So I'm going to repeat this one more time by pointing out to you the reason behind it. I want to use that 177 credit to finance the buying of the $20 call, right? So now I'm on the third step, which is the buying at the money $20 call, right? So also buying this call produces a debit. So again, as I had earlier on the previous slide, point A and point B, same expiry must be selected for all three of these options, and a call execution should be done after the put spread was filled. Call execution should be done right after this put spread is filled. So what I'm doing right now here, again, following the logic of presenting this in the form of the table. Starting with this step C, which is a long $20 call. My long $20 call had produced me a debit of the $2.14. Now that $2 of the 14 cents is a debit structure that I would like to finance by my credit structure. And what do I have as a credit structure? What I have now is an alternative credit structure that it's no longer $20. It's no longer $20 put, but it's a $20 and also a $16. And it's a spread. So this 20 minus 16, it's basically 4, right? That creates the bull put spread, those of you who already know the vocabulary, right? So this $400 is going to be my capital outlay. But then why does it over here says 437? Where do we get the 437? So let's do the math slowly. I have received the credit on this spread by itself for $1.77. I turn around instantly and purchase $20 call at the debit of the $214. So feel free to type in the chat box, did I have enough money of the $1.77 to pay for the $214? And if I didn't, how much am I short? So I'll just take a moment and wait for that because I know it's going to take a few seconds for you to do this. But you know, the beautiful thing is that the platform, such as Thinkorswim, would right away calculate this to you, and it says, like, you're actually short of the $37, right? So you don't have enough. So Orlando was the fastest one to type it. No, you don't have enough. You're short. And of course, in this case, I'm taking away the fees and commission because I don't know what you were able to negotiate in your own case with your own broker, right? You know, so I would be short 37, right? So now that 37, that it's right here, gets added on the top of the 400. And as you can see, 20 minus 16, that's where we get this minus, right? 20 minus 16. It creates the $4 times 100 because each of these is quoted as per contract. So each option contract controls 100 shares. So that's where we get the 400. And this 37 comes from me being short. that gives my outlay of the total of the 437. So now I have presented the long synthetic first, and then the long synthetic alternative. But I want to move on and give you the outcome of how is this looking at the very end. So if you're ready, I'm going to now proceed and explain to you what is really taking place here. So there are multiple different names that we could give to this position. So we can call a bull put spread with the long call. Yeah, that's the one way to name it, right? We can call it, and I personally prefer this more than anything else because it's synthetic long with the protective put just in case something happens. I will not lose my $2,000 because I have at the 16 a right to sell at the 16. So in that case, I'm really protected. But if you understand that this bull put spread with the long call is the same as the synthetic long with the protective put, then we're just filling our mouth full of vocab. It's all semantics. It's all vocabulary. We can just call it simply in our presentation an alternative. An alternative to what? To the long, because that's what we've been discussing ever since the beginning of this session about 35 minutes ago, right? So it doesn't matter which vocabulary you use, as long as you wrap your mind around the concept of what we are doing here. So there can be multiple names. You can hear on the option hour, somebody says a bull put spread with the long call. Another person might be invited. It says it's synthetic long with the protective put. If I'm invited, I would probably just say simply alternative. But in this case, alternative is in the case of the long. So why do we create this alternative? Well, obviously, as I said to you, I created this alternative for one reason. And that reason is simply that I like to have less money invested. So less money invested is what I want. Less money invested. So now I have a side-by-side comparison. And I want to point out to you one more time, on my synthetic long, this was a huge chunk of money, huge chunk of change that I had to pony up for a duration of 210 days. While over here on alternative, without me using all those words, bull put, with, blah, 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 right? On alternative, I'm laying down only 437. So I'm going to just wait for a chat box and ask you, Dirk, Mark, Orlando, Fernando, everybody else who's in it, Mark, which one would you personally select if you felt comfortable that American airline is going to go higher and we're doing this, what I like to call as a one lot, as a one trade, So take a moment. Synthetic long or alternative? So I'm reading Masha. Is the trade same value on the criteria to choose which strike protection to buy the put? For protective put, as I said, I use the volume or share. Any other thing to look at? No, I trade a little bit later in the day. So that's mean like market is open for at least maybe like an hour and a half. By then I know what the contract volume is of that particular leg that I want to say, Michelle. So to reduce the buying power, Dirk said he would choose the alternative. Mark Johnson said he would choose the alternative. Fernando says he would choose the alternative. Orlando said, yeah. And that's why I'm saying, like, I couldn't present to you on the very first time alternative because it would be difficult to wrap your mind around it because of the third leg, right? And when you actually think about it, you can compare the synthetic long to having two kids, So here you have one child, and here you have another child. When you have a third leg, it's almost like a wow, like it's kind of more complex. But the more sophisticated the option is, the better outcome there could be. And this is what exactly I'm going to be pointing out. Amari also type in alternative as long as the delta is quite high. Yeah. And that's what I'm saying. This was the number one thing that I mentioned to you. Something is going to give away now that you have this third leg, which is a bot put at the 16. But overall, I'm still bullish on it. Only I'm not now 100 delta. My delta has dropped by whatever the value of that 16 put is. Masha said, alternative would be slightly reduce the delta. So do we increase the number of the contracts? Marshall, here's the thing. I suggest you do 10 of this in paper to see how it works. Once when you have a 10 data points, look out of the 10 data points, how many of them have worked out. Maybe 7 of them work out and only 3 didn't. Then see what is your average winner versus the average loser. And at that point, say, instead of 1 contract, I'm going to go 2 contracts. So, Marshall, take your time to type in the chat box if you like my suggestion. 10 times simulate this trade with the paper. Do the hard work of selecting one Saturday when you're going to shut yourself in the office and do the calculation. See out of the 10 winners, how many of winners, how many of the losers. See what is the average of those 7 winners, what is the average of these 3 losers, and then decide to promote yourself to the 2 contracts. So I would not jack up right away 4 or 5 contracts to say this is the same outlay of the capital, because Marshall, you would learn the same lesson from the 1 lot that you're placing and from the 4 or 5, So I don't suggest that anybody do that with the 4 or 5 contracts, because the worst thing that can happen to you at the beginning is an option trader to have a winner. Because when you have a winner, it's, oh, this is easy. Why am I conservative? Why don't I go 2 contracts? Why don't I go 3 contracts? And then on one of those subsequent trade, you're going to get hit because it's a loser. And that hit is going to put you back 3 steps because now you have the 3 contracts. So, Marshall, I would really suggest be cautious. Be cautious. Yeah, somebody says, I think Fernanda says he would like to do 30 paper trades on it. Well, you can do the 10, and then you can do additional 10 and additional 10. But after 10, that's a good data pool for you to gather information to figure out whether or not you are allowed to promote yourself to 2 contracts. I would suggest when you're learning, stick to 1. The math is easier, everything is easier. So this is a tab that actually presents my entry on that particular day when we were actually coming down to the support level, and I really felt comfortable entering in that level. So I have a snapshot here of the November 11th. And the reason why I have picked that particular snapshot of the November 11th, so I can show you in pieces what has happened to each of our legs, to our long call and to our put spread. So I'm going to slow down here and I'm going to break it down to you what was happening to the call. So my call costed $214. And now that call is worth $335, right? So you're looking at this is basically increase of the $120 in 1 cent, right? So that's mean that American Airlines has lifted from $19.23, and I don't know if you guys can see it right here, I'm going to circle it, to $21.33. So that's a move of about $2 up. That's $1 of the $2 up. And I have made whatever the delta is, right? Now my put spread that I sold for a credit of the $1.77, I can now close for less because now my $20 put as well as a $16 put that was already out of the money are both out of the money. So in that case, I can say, well, I didn't make all $177 because I need to return them $123, but I had a winning put spread as well as a winning call spread. So feel free to tap in the chat box. How do you like this particular alternative versus just a straight Frankenstein, meaning a long synthetic? So on a $20 call, I have already gained $121. On my put spread, when you subtract 123 from 177, you get an additional $54. $54 on the top of the 121, it gives you $175 in profit. When you divide that by capital outlay of $437, you are really, as Mark Johnson said, love it, 40% up, 40% up. So let me just clear this before I move to the next slide. So it would be unfair for me to say that the long synthetic was a bad trade. It would be, if I would be doing a disservice. It's not. Long synthetic is still a good trade. But now take a moment here and read this one with me. Read this one with me. And I'm going to just temporarily change the color. So when I draw here, so you would see I'm drawing in the yellow, because I want to emphasize now I'm talking about just a regular long synthetic. This long synthetic that I presented earlier was paid $2.11, and now it's worth $3.35. So on a call, we made slightly more. On the call, we made slightly more. But on a put that we sold, we need to now cover it for $2.05. And I hope over here you can see where I'm circling. Asking price of the strike price 20 put. So we sell at a bid, but we cover at ask. It's $2.05. So I'm returning $2.05. That means I didn't make $2.80. I made $75. So the 75 cents on the put. And when you add the 75 cents $75 on the top of the $1.29, it's almost $200. So really, for simplicity's sake, we had the $20 put that was our obligation, and on that $20 put, we made it $20. So any one of you, what did I get? 20 on the 2,000. It's a 10%. So I cannot be saying that the long synthetic is a wrong trade. It's not. But when you compare it side by side to the alternative, and we use the alternative to mitigate the risk, and the most important, I put it in bold, to improve the performance. So we have a side by side here, and we have a conclusion that between the two, the synthetic long had earned us 10%, and alternative had earned us 40%. It risked less and it earned more. Somebody was typing here, what if the American airline went down? Well, at every one of those moves up, I was tightening up my stop. And over here, when that gap was getting filled, I actually got stopped out right here at the 335 for my call, and my spread got stopped out on the other end. So without any hesitation, we are almost at the end of the session. I'm trying to read all these comments that you have. Abash said, absolute returns better on the long synthetic, but return on investment is much better on alternative. Plus, we have a downside protection, and that goes also for Tao Lin, who typed the question, what about if something goes down? If something goes down, both of these trades would get stopped out. So let's now talk about long synthetic. I get stopped down, I took a loss, plus I have a 2 commission on the long synthetic. Tao Lin, how many commissions would I have on my alternative after I get stopped down? 2 or 3? Feel free to type it in. Or any of you in the chat box, feel free to type in. any of you in the chat box, what would we have? So one more time, the reason why I presented the alternative, the whole reason why I presented this alternative was that I would mitigate the risk and, most important, improve the performance. 3, very good. So just be aware of it. We were trading options, but we were treating them as their directional trade, and we will still need to move the stop according to whatever the daily chart is telling us. So we will put below the low of the day. So Jose, if you want to jump in right now and talk a little bit about the waitlist for the option course that we are creating.
Absolutely. Sound check, quick one. Do you guys hear me well? Do you guys hear me?
I can hear you.
Oh, okay. Perfect. Very good. Yeah, perfect. Okay, for a moment I thought that sound was not working well. Yeah, well, thank you so much, Josip. What a session, isn't it, my friends? How was it? Taking a basic options application, if you wish, to such a different level, and it doesn't take that many changes if you think about it. The number of commissions to be paid to execute this trade going from 2 to 3 tells you that basically you just had one more unit. But it's which one and how, and next thing you know, the whole thing changes. So it's pretty cool. So anyway, we are reaching the time to conclude the session. I'd like to mention the fact that we are building a very powerful options course, which is going to be 3 parts. And I wanted everybody to know, in case you didn't know, that there is a wait list for you to put your name on it. So when that course is released, you can be messaged and you become aware of that. So just to make it very simple, I'm just gonna activate on the chat box a clickable button that will send you to the page for you to register yourself for the wait list, assuming that you need options education. I know many of you here are quite experienced already, so that may not be what you need, but for the ones of you that require it or need it, that could be very useful. And then the other thing I wanted to mention as well, which some of you are part already of our coaching plan, I wanted to mention the coaching plan for the ones of you that don't know what's the coaching plan and the fact that the coaching plan exists, which basically the coaching plan is the collection of live trading sessions that we do during the weekdays. Actually, also during the weekend, even though in the weekend is not really live trading, it's more educational and lecture type. But during the weekdays is trading. And this is important because learning and developing yourself as a good trader implies, of course, knowledge. And that's what you basically acquire today with the webinar and many more to come. But putting that on the side, you take the knowledge, practice, and now the knowledge becomes a skill. That's the real power. So being guided, having someone to ask questions as you practice, to me, it's really key. And that's the reason for those live trading sessions that we do. So you can become a master of top, a master of our technologies, a master of the markets, a master, of course, of the various options tactics that you choose to use. They all have pros and cons, and they need to be aligned with your trading plan. So on top of that, very cool, in case you didn't know, and I know some of you know, Josip will be part of our schedule starting in January as well. So he'll be participating of those live trading sessions, and I believe that this could be quite amazingly enriching for everybody in our community, and we are super excited for that. And we thank you very much, Josip, for being up and to team up and being part of our team. So
I'm excited. I'm excited even to mention about the articles that is going to be coming up soon, kind of summarize all this presentation.
Very good. Yes. So this is another thing that will be very cool, is that many of those lectures that we're going to be conducting and so on will then become an article like the one we will be publishing very soon, that has been produced by Josip, talking precisely about the subject of the synthetics and the alternatives and everything else. So lots of good things going on, and hopefully you guys will be able to really enjoy it and take advantage of it and spread the word as well, because there are many options lovers out there that they may not be in the right place from a profitability, results, consistency, peace of mind, and many times it's because they lack on that key knowledge, that key tool, that key support, that key community. Sometimes is about not being isolated, And I think that we provide a lot of that, and we are very passionate, as you guys know. So just share the word, share the love with people out there. So it's good for everyone. And the one link I just activated a moment ago as well is the one for you to register for that coaching plan. The coaching plan is something that is paid unless you are a top subscriber, and then you have it for free. But at the same time, here the link I just shared in the chat box is a 3 months free access to the coaching plan, so you guys can experience it, see us in action if you haven't done it yet, and again, just be part of what we do. With all of this said, that's kind of like all. We are just getting to the last slide of the day, and if there is any remaining question for Josip or myself, more than happy to receive it, and more than happy to answer it. And we still got 5 minutes, so we can indeed talk about it. And if there are no questions, so then I guess we'll call it a day. But for sure, guys, anything that you like to ask, this is your time. So go for it.
I just want to answer one question. I think it was typed earlier. I wish I knew this 5 years ago. Somebody typed in. I think it was you, Mark. When I did the last presentation, I talk about the scientific theory of osmosis, how dense needs to filter through less dense. And I'm not quite sure if everybody picked up what I was trying to lay down with this. As a new option trader, there's this tendency, I need to learn everything. It's not bad to learn everything, but at the end of the day, you really need to focus on something, and that's why I started this presentation talking about one single instrument. Pick the one instrument, pick the long synthetic or pick the long synthetic alternative and drill it 10 times. You're still bullish, but you're not doing now bull call and all sorts of butterflies and exotic stuff. Just focus on the one. Trade it 10 times consistently, and then take the one Saturday for a couple of hours to look at these results and to figure out, what did I do wrong? How can I improve this? Had I move my stop tighter, or whatever, the trading is really a journey about yourself. So feel free to type in any other questions that you have just before we wrap it up.
Yeah, that's so important. Even if we put options on the side and we just focus on simple assets to trade, such as stocks or anything that only gives you two choices, long or short, that's it. Even with that, you find so many traders in the world that have all this incredible knowledge about that particular market, but then they don't have a trading plan that tells them exactly what is it that they do, what type of stocks they trade, what technique they use to set targets, what techniques they use to set entries. They don't have it, and that of course creates lack of consistency in action and therefore lack of consistency in result. Now you add a layer with options, where options give you options, and you have different strategies and combinations of strategies, variations of combinations of strategies. Next thing you know, it's amazing, but it could actually be the opposite of amazing if you don't have structure. So a great way to think of structure is take one of the tactics at a time, and the tactics that you understand that their pros and cons are in line with what you're trying to accomplish as a trader. For example, if what you're trying to accomplish as a trader, you understand the alternative synthetic that was presented provides advantages and disadvantages that are in line with a reasonable outcome, in line with you, just put those rules and put that tactic in your trading plan, and that's what you trade. And then if you have more time, or you are more advanced, or whatever, or you want to be more diversified, whatever, nothing wrong with having more strategies. But as long as everything is very clearly strategized in the sense of methodical, mechanical, under control, rule-based, and on top of that, you've practiced enough so you understand what you got in your hands. Josip said at least 10 times, and 10 times is just to begin understanding what you got in your hands, isn't it? So anyway, there is a question there from Mario and Mark. Would it be possible to see the risk graph of the alternative long? Well, not into the session, unfortunately, Mario, because we are wrapping up already. But for sure, in the live sessions, we can certainly look at that. And again, as happy to show myself. And in no time, you'll have Josip there. So certainly you can do that. And Mark, what I want to do is to trade SPY ETF and other tickers in my retirement account. Jose knows why. Got it. Yes, indeed, Mark. Very good. Well, I think we are almost hitting the top of the hour. Josip, any last thought, comment, something you have to share with the guys?
Just a comment to Mark. I love the fact that you mentioned SPY and the SPDR ETFs, because first of all, you need to select the instrument that you believe in if you're bullish on it, So when I selected American Airline, I did my technical analysis and I'm like, well, if this company didn't disappear during the Corona, I mean, they're going to be in business. Same Bank of America didn't collapse, because the name Bank of America worldwide is known, right? While the Wells Fargo and some other companies, Washington Mutual, they went through their own struggle, right? So you got to pick the instrument that you believe in before you start trading it, right? So that's all for today.
Wonderful, my friends. Thank you so much for joining us, Gavin. Good to see you, my friend. Great presentation, Josip and Jose. Definitely want to practice. Thank you for the knowledge, the experience. Much appreciated. You are appreciated, Gavin. Thank you so much, my friend, and everyone. It's been a pleasure to spending this 1 hour with all of you. Special and super thank you for Josip as well for sharing all this knowledge and your passion as well.
Thank you for having me.
And we will see you all very soon, and hopefully in the live sessions. You guys take care. Bye-bye, everyone.
Bye.